History is repeating itself. Another subprime bubble is about to burst. As we're about to uncover, the US federal government has been quietly covering the mortgage payments for hundreds of thousands of defaulted borrowers. For years, there have been rumors of this happening, but finally, after a massive investigation by the New York Times and an ex-investigator, there is now overwhelming evidence showing how the government is essentially covering up residential bankruptcies, propping up the market, and subsidizing the sky-high prices we've seen since the pandemic using your tax dollars. Once I show you the details, you will be absolutely shocked, and if this key program ends up on the Doge chopping block as it should, it could quickly unravel much of the momentum driving various housing markets across the US. This story all starts with one of the most mysterious apparatuses of the federal government called the FHA mortgage program. I'm sure many of you watching know a thing or two about this program, as it was originally meant for brand new buyers, alternatively called the Federal First Time Buyer Program. It allows people to put as little as 3.5% down to buy a house, and this all sounds great on paper. Who wouldn't take advantage of that, especially as a lower income first time buyer? But just like all things government, what started off as a small niche program intended to help Americans get into starter homes has grown into what I would call mortgage nationalization, where the government essentially took over the housing and mortgage market. You might think I'm exaggerating, but my point is very valid when you look at the data. Take, for example, D.R. Horton. They are America's largest home builder. In 2024, the average new home they built cost $378,000. And if you take a quick look at their earnings call, you will see that FHA and VA loans accounted for 60% of their mortgage company's volume. This means that the majority of their mortgage customers rely on the government for a loan, and you can make the argument that a large portion of D.R. Horton's business is subsidized by us, the taxpayers, via the FHA program. How many of those customers would even qualify if they had to go through the private markets? Remember, an FHA loan is government-backed, meaning that the bank is typically not liable in a default, so the requirements are obviously going to be less strict from the lender's perspective. Today, you can get an FHA loan with a 580 credit score and put 3.5% down, and if you don't have the 3.5%, HUD will even help you find a down payment assistance program to cover that tiny amount. It's a joke. Over the years, the standard kept getting lowered. The federal government has essentially allowed borrowers to take out bigger mortgages than they can afford. And worst of all, to prevent foreclosures, it's bailing them out when they miss payments. We essentially took the subprime crises of 2008 and wrapped it up in a nice-sounding government program. Now, a lot of you watching will probably disagree with me, and you'll likely comment saying these loans have legit proofs of income, and this isn't subprime because the standards of proof nowadays are way higher. But just take 1 second to read that article linked in the description and you'll probably change your mind. In 2000, the average debt to income ratio for an FHA borrower was 20%. Today, it's 65%. Most lenders recommend no more than 28%. That tells you these government loan portfolios are layered with bad loans, but since they're owned by the taxpayers, it's supposedly all good until it isn't. In fact, about 7.05% of FHA mortgages issued last year went seriously delinquent. That's more than the 2008 peak of the subprime bubble, which was at 7.02%. And it looks like it's getting worse. These loans are simply not getting paid, which usually acts as a canary in the coal mine for the overall mortgage market. Recent FHA trends have caused alarm bells to ring across the sector. Just take a listen to this recent CNBC report where they went over exactly this, showcasing just how bad things are getting under the hood.
But you also know that as a percentage of income, that debt load has mostly been manageable. High debt, but guess what? We can afford it. But now some of that is beginning to change. For more on both the housing and car stories, let's bring in Diana Olick and Phil LeBeau. Diana, let's start with you. What are you seeing in one particularly, call it fragile part of the mortgage market?
Well, Brian, the mortgage delinquency rate, has been really low for nearly a decade. And aside from a very brief jump at the start of the pandemic before those government forbearance programs, it's now sitting at just 3.98% overall, that according to the Mortgage Bankers Association. Compare that to just over 10% back in 2010 during the subprime crisis. The mortgage landscape, I'm saying, is quite healthy, with one major red flag. FHA loans, their delinquency rate, while always higher, has been rising recently, now hitting 11.3%, and that is the highest since 2013. Here's why.
All of the stresses in life we're seeing right now, a little bit of softening in the job market. We're seeing big jumps in insurance premiums as a result of all of the hazards out there, whether they be wildfires, hurricanes, what have you. All of that leading to some stress.
FHA attracts first-time buyers with lower incomes and credit scores. The FHA down payment requirement is just 3.5%, and borrowers can carry higher debt compared to their income, that so-called DTI. And that's because FHA borrowers have to pay mortgage insurance. But FHA recently lowered that insurance premium, which brought in more borrowers. That resulted in higher credit levels of the entire program, but that debt to income is still very high, and that's because of inflation and affordability, high home prices. The MBA is also reporting a big jump in buyers of newly built homes going to FHA. It's gone from 10% just a few years ago to 30% today, and I'll say it again, Brian, because of high home prices.
But here's the worst thing about this. The government isn't even allowing these bad mortgages to go into default, which is essentially propping up the entire market. It started with the last administration. Under the guise of pandemic relief, the administration masked the growing troubles in the housing market by paying off borrowers and mortgage servicers to prevent foreclosures. Of the 52,531 FHA loans last year that went seriously delinquent within their first year, only 9 resulted in foreclosure. The FHA actually introduced a program that pays mortgage servicers to make borrowers miss payments for them. Missed payments are added to the loan's principal but without interest. It's essentially a glorified government grant. The FHA also pays servicers to cut monthly payments for delinquent borrowers by 25% for 3 years, with the payment reductions also added to the principal without interest. Essentially, the government got rid of bankruptcies. And this isn't just some Wall Street Journal BS. We can prove it with a very specific example. This is John Comiskey on X. I really don't know why this isn't a bigger story because it's absolutely shocking. John, I believe, is an engineer at a mortgage tech company, and he's got some serious skill in finding these gem examples in the FHA program. He regularly combs the Ginnie Mae MBS disclosure database for evidence of this happening and occasionally tweets out what he calls the FHA loan of the day. It's actually amazing. Give him a follow. He deserves more attention on this. In this specific case, he found an FHA loan for a guy who took out a $236,000 loan at 3.5% in Tennessee in early 2020. The first due date on this loan was the 1st of May 2020. From July 2020 to July 2022, a period of 26 months, including the May 1st date, this guy made 0 payments. That summer, the FHA stepped in and provided a partial claim of $38,000 to cover the missed payments in that period. This brings the loan current, meaning the arrears are paid off, but it added a 0-interest subordinate lien to the back of the loan. Essentially, this is just a government payment with a promise that the borrower will eventually pay later or when he sells the house. So this man in Tennessee is now 2 years into this house, living basically for free, but it gets worse. From July 2022 to April 2023, a period lasting 9 months, this man in this real example once again makes 0 payments. And again, the FHA issues a partial claim of $13,000 to cover the 9 months of missed payments from 2022 to 2023. This once again brings the loan current, adding to the zero interest subordinate lien. The borrower has now been in the home for 3 years without a single payment, but it gets worse once again. From April 2023 to November 2024, 19 months, this borrower, you guessed it, makes 0 payments once again. 5 years without a payment since the loan started in May of 2020. Now, instead of finally foreclosing that November, the loan is modified. The interest rate is raised from 3.5% to 7.25%, and the monthly payment increases by approximately $400. Not sure how that's going to help with payments, but to recap, that's 5 years with no payments and no foreclosure. That is straight up fraud and needs to be stopped, and it's probably a big reason why the market can't seem to correct, because the government has essentially outlawed bankruptcy. It will be interesting to see if Doge deals with these issues or if the government just looks the other way to avoid a housing meltdown. Let me know what you think in the comments below, and as always, please make sure you hit that like and subscribe button if you enjoyed it.